So if I could know what you people, what understanding you people have about the stock markets, yeah. So Syed, our friend Syed is telling that stock market is a place where you can make your money work for you. Okay, so that's the right answer. And obviously, what is the reason that makes people interested to the markets? Is it because it's a place where you pass time? It's a platform for investment and buying ownership in companies. Yeah, exactly. Source of income opportunity for students to learn and earn, of course. Stock market basically an investment option where we can invest and either earn or lose. Okay, yeah. So obviously the reason why people get attracted to the stock markets is nothing else but because of the income generating potential. Okay, stock market is a place where you can make a huge amount of money. Similarly, it's a place where you can lose a lot of money. Okay. And I don't know if you know, 90% of the people in the Indian stock markets they lose money. And there's just 10% of the people who are making money from the stock markets. So my next question is like, even though you know that 90% of the people are losing money in the stock markets, what makes you kind of attracted towards the market? If you don't mind, if you could answer me, please let me know. What do you feel? What could be the reason? Even though most of the people lose money, like what is that factor that is making people attracted towards the markets? And obviously the answer is that even though most of the people are losing money, still people get attracted to it because it's the rest 10 percentage who are making money, right? And that rest 10 percentage, you know that they are making a huge lot of money. Okay, all the 90 percentage people who are losing money, they're kind of feeding this 10 percentage people who are making the good money from the markets. And now what I would like to say is definitely anybody can make money. Definitely anybody in the sense somebody who has the right skills, somebody who is passionate about it, somebody who is interested uh, in it, who takes efforts to learn what works and what doesn't work, he is capable of making money. But most of the problem in Indian markets is that most of the people get into the markets just thinking that okay, I can become rich like uh, in 1 month or like 2 weeks, 3 weeks. I can become rich tomorrow. If I invest 1,000 rupee tomorrow itself, I'm looking forward for getting rich. Okay, and I'll tell you, so that doesn't work. So just like in any other profession, you should consider like stock trading or investing in the markets just like any other profession. So if you're kind of putting in a lot of efforts, understanding what works, what doesn't work, this will help you to realize what you should be doing and what you should not be doing. So there is one saying, okay, wise people learn from their mistakes, but wiser people learn from others' mistakes. So if you're wise, you will always try to learn from your mistakes. If you're wiser, that means you will also take into consideration the mistakes that other people have made. Fine. So now what is very much important in the stock markets is first of all discipline. You should be really disciplined about the markets. Even before entering a trade, you should get to know why you are entering the trade. What is the reason? Obviously to make money. Apart from that, there should be a reason that is justifying your entry position. So just don't buy and sell watching news, or just don't buy and sell when your friend says, or just don't get into the markets watching some random movies like Wolf of Wall Street. Things like that is not like possible. It doesn't work that way. Okay. So what you should be doing is you should learn about the stocks first of all. So something that I always mention is that so we have right now we have like 52 attendees over here. Okay, so if I ask you, so we have, for example, like let's take the first person. So let's take who was the last person? So Akil. So Akil said that stock markets can provide you an extra source of income with proper knowledge. So Akil, if I'm asking you, to describe a friend of yours whom you have met 1 year back, and I ask you to describe a friend whom you have met like 1 week back. Which friend will you be able to describe in a much better manner? The friend whom you met 1 year back, or the friend whom you have been knowing just for the last 1 week? Which friend would you be able to describe in a much better manner? Akhil, could you please answer? The friend whom I met, whom Akhil has met 1 year back, of course. The reason is that with this friend whom Akhil has met 1 year back, he has shared a lot of experiences with the friend. He knows how that particular friend is going to behave when a positive situation happens or when a negative situation happens, how the friend is going to behave. So Akhil is kind of very much familiar with the friend's behavior. Okay, and that is the very reason why Akhil is saying he'll be able to describe the friend whom he met 1 year back in a much better manner than the friend whom he met just 1 week back. So similarly, each and every stock has a behavior. Each and every stock in the stock markets has a behavior. So if we are kind of following up with the stocks on a daily basis, okay, at least on a weekly basis, if you're kind of understanding what is the trend, how is the stock behaving, what all are the factors that has made an influence on the stock, then the advantage that you get is you get to know if a similar kind of situation is happening at a later point of time, what is the probability that a similar kind or a set of conditions can happen. So let me tell you, let's say that you got 100 out of 100 for your maths class test. Okay, you got 100 out of 100 for your maths class test. So now your best friend knows how you behave when you got 100 out of 100 for a maths class test. Now let's say that the next semester too, you're scoring like 100 out of 100 for your maths class test. So now your best friend is going to predict what is the behavior that you're going to take, or how you're going to behave the next time you get 100 out of 100, based on how you have behaved the previous semester when you go the same kind of marks, right? So similarly, if we kind of watch our stocks, if we kind of observe stocks for a while, we'll be able to track their behavior. What are the characteristics associated with it? All these things. And that is what is the importance of data. So all these things, like I gave you this friend's example. So when we look at stocks, we kind of consider them as data. So how stocks move, the range in which it moves, what is the pace at which moves. That means does it go all how much percentage change can we expect? What is the speed at which the price changes? All these things matter. So all these things are data. So based on data, we'll be able to filter out certain set of conditions. If this condition is happening, what is the probability that the next day the price should go up, or the next minute or the next hour the price should go up, based on a similar kind of situation that has happened at an earlier point of time. Okay, so that is the importance of data. So before that, let's get started with the PPT. So as all of you know, some of you have already answered, a stock market is nothing else but a place where buyers and sellers meet. So if I'm somebody who wants to purchase stocks, I place a buy order at the stock exchange. And if there is somebody else who is willing to sell a share, he places a sell order at the stock exchange. So a stock exchange acts as the meeting place for buyers and sellers. Just like we have our markets, right? Where you buy vegetables, where you buy fruits, all these things. Similarly, the stock market is a place where the stock exchange is the place where buyers and sellers meet. So stock market is actually the collection of stock exchanges. Or to bring it down to simpler terms, we know e-commerce, right? So Flipkart, Amazon, and all are a part of the e-commerce ecosystem. Similarly, in India, the major stock exchanges are National Stock Exchange and Bombay Stock Exchange. So the National Stock Exchange and Bombay Stock Exchange are the major stock exchanges in India. The stock exchanges across the world comprise the term what we call as the stock markets. Okay, so it's a collective word. So let's get started. As I said, the stock exchange is nothing else but a meeting place for buyers and sellers. So today's session, like what we kind of are going to focus is like we are going to discuss a bit about the opportunities present in the stock markets, how one can make use of these opportunities. So of course, it's a place where you can build wealth. Okay, so you people must be familiar about businessmen like Reliance, like Ambani, businesses like Reliance, Tata, all these things, right? So if you understand that a business is doing good, so let's say that I feel that Reliance is doing really good business, but it's kind of not possible for an individual like me to start a company like Reliance in a year, two, or let's say even 5 to 10 years. It's kind of not possible. But if I feel the company Reliance is having good potential for the next 5 years, or let's say for the next 10 years, if I feel that the company Reliance is going to do really good business, then what I can do is I can invest in the company Reliance. So if I invest in Reliance, if the business is going to do good, that means if the business is doing good, more and more people will be willing to purchase the shares of Reliance, right? So more and more people they'll be interested in purchasing the shares of Reliance. So if more and more people are kind of willing to purchase the shares of Reliance, that means the demand is increasing. Okay, so demand increasing, what do you mean by that? So what should happen to the price if the demand is increasing? Could you please answer? If the demand is increasing, what do you feel is going to happen to the price of the stock? Just try answering. Even if it goes wrong, it's perfectly fine because we all learn from mistakes. Yeah. If the demand is increasing, of course, the price will go up. Right? As you people are answering, the price will start increasing. If I feel the company is going to do good, the business is doing good, the demand will increase and the price of the shares will also go up. Okay. So that means if I'm investing like 1,400 rupees today, if after 5 years, if the value becomes, let's say, 3,500, that means my 1,500, it is becoming 3,500. So I'm receiving a capital appreciation of 2,000 rupee, right? So that is like I am receiving a capital appreciation of 2,000 rupees. That is more than 100% of my investment. So that is one method. If you feel that a business is going to do good, rather than starting a similar business, you can invest in companies that are following the same business model. Okay, if you feel a business model is good or a company, it has a good management, the company has good tie-ups with the government is also supporting the company. Okay, so in that manner too, you can find out stocks, you can find out companies, invest in the stocks of those companies. So you can look for a gradual growth in your investment. You can look for capital appreciation. So you call it as capital appreciation. Okay. So rather than starting a company from scratch, if you understand that the company is doing good, you can invest in the company. So you're just becoming like a business partner. Okay. So next slide is what are stocks actually? So the definition is that stocks are investments that allows you to own a portion of the public corporation. Okay, so a company that lists itself on the stock exchange, a company which has been listed itself on the stock exchange, you can purchase shares of the company. Okay, so we call them as public companies. So Reliance Industries, Tata Motors, Vedanta Limited, Britannia, all these things are publicly listed companies. That means the company has listed itself on the stock exchange and people can purchase the shares of those companies. Okay. So those partial ownerships of the company is what we call as shares. And anybody who owns shares of the companies have actually a portion, is owning a portion of the publicly listed company. Okay. Now, the reason why you invest in the company, that is the fact that I have mentioned initially itself, that you are looking for returns on your investment. That is capital appreciation. If there is an increased demand, definitely the price of the company is going to go up. you're going to receive capital appreciation. So that is the purpose why you are investing in the company, right? Now let's see the next slide. Stock exchange. As I have mentioned, a stock exchange is nothing else but a meeting place for buyers and sellers. Now we have also discussed about the stock markets. Is the collection is a collective term we use. Collection of stock exchanges is what we consider as the stock markets. And in India, the major stock exchanges are Bombay Stock Exchange, National Stock Exchange, Calcutta Stock Exchange, etc. But as a trader or an investor is concerned, is the Bombay Stock Exchange and National Stock Exchange which gives weightage, like which is of importance to us, because that is the place where most of the trading activities take place. So it's more than enough that we just consider the National Stock Exchange and Bombay Stock Exchange. Okay. No, yeah, that's what I was mentioning. The two major stock exchanges in India, the National Stock Exchange and Bombay Stock Exchange. Now, our question is, so let's say that I have a company, like our firm's name is Livelong Technologies Private Limited. Okay, so if you didn't know, Livelong Wealth. So Livelong Wealth, Livelong Technologies Private Limited. Explain strategies. Can you please tell how option change? Okay, so all these things like is kind of beyond the scope of this session. So we're just going to discuss the basics. So my question is, what could be the reason why a company lists itself on the stock exchange? So I was mentioning that we have a firm called Livelong Technologies Private Limited. That's the name of our firm. Okay. So from a private limited company, what is the reason that we should consider listing the company on the stock exchange? For raise funds from the market, more funds for growth, exactly. So yeah, obviously. The reason why a company should be listed on the stock exchange is due to the following reasons. Okay. First one, to raise funds. So let's say that I started a company by borrowing money from my parents, my friends, from the bank, all these things. Okay. So do you think that the bank is going to keep on like giving you money as and when you ask? No. But but if there comes a situation where that I want to raise money, but I don't want to, I'm not like I don't want to pay interest to the bank, or I don't want to borrow it from the bank, or let's say that I want to borrow like considerably a large amount of money. What I can do is, if my company is showing some good business, okay, I'll tell you the conditions for undergoing an IPO. So if my company wants to go into further business expansion, then I can consider listing my company on the stock exchange. The process is called as IPO, Initial Public Offering. That is the process in which a company lists itself on the stock exchange for the very first time. So when I undergo IPO, my shares, okay, a part of my company shares is going to be listed on the exchange and sold to the public. So the public, they can purchase shares, and when they kind of subscribe to the shares, I get the money, right? So I can use this money for further business expansion. We can get into new business ventures. We can kind of boost our business. Apart from that, the other reason is that to divide risk. So let's say that my company is kind of getting into a business model that we are kind of not so sure about. So we are obviously everybody does business to make money, but this time like I'm not so sure about the business model. But so I kind of don't want to risk my entire capital. That is like by investing on the business by myself alone, I don't want to risk my wealth. Instead, what I can do is the company has been publicly listed. The public's money is also there. That means we are kind of dividing risk amongst the shareholders. That is, each and every shareholder is taking a part of the risk. Okay. Another reason is, you people must be knowing that most of the billionaires in the world, okay, most of the billionaires like Jeff Bezos, Bill Gates, all these people, it's not that this money that they have is in their bank account. It's not there in their bank account, but it's along with the valuation of the shares that they hold in their respective companies that their valuation is stored. So if your company, like if I say that I have a company that is worth X crores, there is no use in that. Like I can say whatever value I want, X crores. But that X crores is there in my mind. It must be there in some papers. But I can't make those X crores into currency. In the sense I can't exchange it with currency. So that is where liquidity comes in. So when I say liquidity, what the term means is liquidity is the ease with which something can be exchanged with money. Okay. So if I ask you, uh, is real estate a liquid form of investment? What do you guys feel? You could just type in the chat box. I can kind of see your questions. I can answer here and there. So, what do you think? Is real estate investment a liquid form of investment? So, no, because it's a big process. You need to kind of need to kind of undergo a lot of paperwork, etc., etc. So you can buy land. You need to find a person who is willing to buy it from you. The paper was not a liquid form of investment. What about gold? Is gold a liquid form of investment? Gold. So the answer is yes. If you have gold with you, you can kind of easily exchange it with money. It's not so liquid, but it's liquid. It's considered liquid. In India, at least, it's considered liquid because you can kind of exchange it whatever the value is. Okay, I'm not talking about the jewelry items. I'm talking about the biscuits of the coins at least. Okay, gold is a commodity. Yeah, so gold can be considered liquid. Like you can kind of exchange it for money. So can you tell me what are the most liquid thing then? What could be the most liquid? Banking, stocks. Okay, so the most liquid thing is currency itself. The Indian rupee note that we have, right? That is the currency itself is the most liquid. So liquidity is nothing else but the ease with which something can be exchanged with money, currency. Okay, so currency itself is the most liquid. So you can, what do you say? You can exchange. So shares are also very liquid forms of investment. That means if you have 1,000 shares of Reliance and it has like thousand, you have purchased 1,000 shares of Reliance, you have invested in 1,000 shares of Reliance. The next day you feel okay, I need to withdraw money. What you can do is you can sell out these shares easily in the stock exchange. So they won't be in situation where there are like no person who's coming to buy your shares. If your company is like, if you have invested in a company like from the Nifty 50 index, the volume is going to be very high. Volume is going to be high means a large number of people are purchasing and selling that particular stock. So whenever you want to purchase, whenever you want to sell it off, there is always somebody else on the other hand side who is looking forward to buy it. Okay, so that's the reason why stocks are considered liquid, and that's one more reason why if like the fact of liquidity that attracts this company founders to let their company become public. Another reason is increased market value. Let's see any idea like by how much the value of Tesla shares rose up. I'll just show you. Tesla share price, like, can someone try to answer like by how much percentage that the share price of Tesla rose? Okay, yeah. So just show you the graph. So some of you are already aware. I'll just show you the graph. I'm just taking the chart. Just a second, guys. Okay, I hope you can see my screen now. I'm just sharing my screen. The screen is being shared. Yeah. So this is a chart of Tesla. Okay, this is the 1 month chart. If you kind of have a look over here, what we understand is that January 1st onward, like if you kind of consider January 1st, the price of Tesla, January 5th, okay, the price was at $185. Right now, the price is like $800. Okay, so that has been a steep increase from 185 to $800. Fine, 185 to 800, that has been a very steep increase in the pricing of Tesla. So that is one more reason why companies go public. So the reason is that nothing else, but if a company is listed on the exchange, so this increased demand, right? This increased demand, it can really boost the pricing of the stocks. So if people feel the business is doing good, if the business has a huge potential, this is going to boost the this is going to boost the pricing of the shares like really high. That is going to shoot up. So that is what we see. That is what we saw in the charts. Okay. So increased market valuation of the firm. So if the market valuation of the firm is increasing, it's not just the valuation of the firm, but the valuation of the net worth of the founders or the investors of the company is also going to go up because they are the ones who are holding a majority of the stake in the company, right? So that is another reason why companies go public. Now we'll just quickly see what are the uh, what do you say consequences. So loss of control, of course. So if the company is listed on the public, the founders of the company will be having to take some kind of decisions that is just to please the public rather than looking at the. It happens like less often, but there can be situations where the founders have to think about how investors are going to react or how the public will perceive the decisions. Okay, then market pressure. So each and every tweets, Trump tweets, or our government's tweets, all these things, or what do you say, like what is happening with the economy, all these things will drive the market. The market fluctuates a lot based on news, right? So as a result, the price of the stocks will also keep changing. Okay, if the company is public, so that is another factor. Apart from this, is an expensive process. Expensive process means the process of undergoing an IPO is kind of like quite expensive for new companies. Then when a company is listing itself on the stock exchange, it has to kind of share a lot of information related to its business, which they never used to what do you say reveal earlier. Okay, which they never used to open up to the public earlier. So this is kind of like the competitors, they get to know this data. And apart from this, there is this concept called short selling. Short selling means, I'll come to that in the coming slides. To give you a basic understanding, so most of the people think that they can make money only when the price of the shares are going to go up. Okay, so they have this feeling that they can make money only if the price of the shares are going to go up. And that's not true. You can make money in the stock markets even if the price is falling down. That is not just when the price of the shares go up, but even if the price of the shares fall down, you can make money. And that process is what we call as short selling, meaning you sell something first and you buy it back at a lower price. So, for example, let's say that we have our friend Ashish over here. Okay, so okay, just a second. Ashish is asking, can this steep rally sustain? So there can be pullbacks in this rally, and you can kind of consider these pullbacks to accumulate. Okay, so let's say that Ashish is having 1,000 shares of Tata Motors, and tomorrow I have a feeling that Tata Motors shares are going to fall down. So Ashish is not going to do anything with these 1,000 shares. So if I feel the price of Tata Motors is going to fall down, what I can do is I can borrow some shares from Ashish. I can sell it off in the stock exchange. Once the price has fell down, I'll buy back those shares and I return it back to Ashish. So I borrow it from Ashish, then I sell it off. Then once the price falls down, I buy it back and return those shares to Ashish. So that's the concept of short selling. Fine. So in people can short sell on publicly listed companies, which will kind of create an artificial supply. That means people short selling the stocks, pushing the price down. So if the price is being pushed down, what is going to happen is that the price of the shares will fall down, right? So that is kind of bad for the publicly listed company. So that's the thing. Okay. So now we were talking about the two major stock exchanges in India. The first one, NSE, National Stock Exchange, and the second one, BSE, Bombay Stock Exchange. Okay. Now, I guess almost all of you must have heard about the term Nifty 50. Okay. I guess almost all of you must have heard about the firm Nifty, not about the firm, about the index Nifty 50, and you must have heard about Sensex too. Okay. So we'll come. There are nothing else but indices. I'll come to that now. I'll come to that in the coming slide. So for the National Stock Exchange, Nifty 50 is the index. So index is nothing else but something that we consider as the benchmark. Okay. So for example, like I don't know, if you like, let's say that you have a class, like in your classroom, there'll be some students with whom you kind of compare your performance. Okay, he is of my level, he is of my knowledge level. Then we both must be scoring the similar mark, a similar kind of marks, right? So similarly, we have something called as the index. So it's a benchmark, something that we use to compare the performance of a stock with the overall average. So Nifty 50 is the index of National Stock Exchange, and Nifty 50, the National Stock Exchange became recognized as a stock exchange in 1993. It presently has over 1,600 companies listed on the company. That means 1,600 plus publicly listed companies on the National Stock Exchange. Talking about Bombay Stock Exchange, Sensex 30 is the index, meaning that is the benchmark, and it became recognized as a stock exchange in 1957 with over 5,000 plus companies listed on it presently. Fine. So let's speak a bit about indices. So they are used as benchmarks to gauge the movement and performance of different market segments. So nothing else, as I said, they are the benchmark or they are the standards with which you perform the overall performance of a particular sector or a particular, what do you say, segment, you can say. As I gave you this example, like if I have a classroom, like I usually compare, I'll be comparing my performance in class test with my friend circle people, right? So similarly, there will be like one close friend of yours with whom you kind of compare your marks. So same way, index is something which we use as a benchmark to compare our performance. Fine. Now, I'll before we move to the slide, like I'll just show you the website of National Stock Exchange and Bombay Stock Exchange. So just give me a minute. I'm just sharing the. Okay. So nseindia.com. This is a website for National Stock Exchange. Okay, so over here we kind of get to know what has been the performance of the index, which all stocks had gained the most the previous day, which all stocks fell down in price on the previous day. All these things we get to know. So right now we understand that the value of the index Nifty 50 is 12,113.45. The price has dropped by like 61 rupees last Friday. Okay, and you can kind of see the chart of the index as well. And Nifty 50, why the name, you must be having the doubt. So what I would like to say is the index Nifty 50, the benchmark, it takes into consideration the weighted average of the top 50 companies listed on the National Stock Exchange in terms of market capitalization, free float market capitalization to be precise. Okay. So what actually happens is, like you can see, these are the companies which constitutes the Nifty 50: Yes Bank, Bharati Airtel, UPL, BPCL, Seal, Asian Paints, Wipro, HDFC, Bajaj Finserv, Infosys, Vedanta Limited, ONGC, Hero Motor Corporation, IndusInd Bank, Gale, all these things, right? So these are the companies which are leading in the national stock exchange in terms of free float market capitalization. So free float market capitalization is nothing else but the amount of money that has been raised. So if people start raising funds, the reason why companies list, we also saw that. So free float market capitalization is the amount of money that has been raised by listing a company on the stock exchange. Okay. So in terms of that, that is the reason why these are the companies, these are the top companies in terms of free float market capitalization, and their weighted average multiplied by a base value multiplication factor. So no need to consider about that. So that is how we get the value of the index. So this index kind of tells us what is the average performance of the stocks that is listed on the Nifty 50 index. These 50 stocks, their performance, weighted average performance, is taken into consideration for calculation of the index. And of course, the weightage is different. That is like Reliance, HDFC. These companies are given like more weightage. And you can say that the direction of the index kind of tells you what is the overall sentiment of the traders and investors in the Indian stock exchange uh, on the markets. That like the movement of the Nifty 50 index kind of tells us like where the what is the overall sentiment, what is the opinion of the investors and traders about the Indian markets, the future of the Indian markets, as we can say. Fine. Now, next thing, okay. So I hope you got a basic understanding of that. So I will also show you the site of Bombay Stock Exchange. So there's a site. Okay, so Bombay Stock Exchange is not so like as far as a trader is concerned. National Stock Exchange is more preferred because that is the place where more number of people actively participate. So this is the site of Bombay Stock Exchange, bseindia.com. Okay, so I personally stick to trading on National Stock Exchange because the volume is much higher in National Stock Exchange. Volume is higher, meaning more number of people actively participate in trading in the National Stock Exchange. So obviously, more number of people meaning is much better to trade. Because let's take a situation. Okay, so let's say that I am a shopkeeper and we have like 68 people here. Okay, so let's say that I'm a person who is selling a mobile phone. So I'm a person who is selling a mobile phone, and there are like 68 people coming to my shop to purchase a mobile phone. So now what is going to happen? In the sense, let's say that I have only like 5 mobile phones in stock with me. So what I'm going to do is I'm going to bargain with you people. So if the price of the phone is let's say 10,000 rupee, I'll tell you I'll sell it to you only for 15,000. And since there are many number of people, so you people will be like, some of you will be in like high emergency that you want to make a purchase soon, and you might consider buying it from even for 15,000. Okay, I'm not this vague values we don't take into. Okay, so you think that okay, I have to buy it now. So I am the person who is having options because you people are the ones who like there's a huge demand but the supply is very less. There's a demand of 68 while the supply is just 5. So I'll make use of that advantage. I'll increase the price and sell it to you. Now what if there are 68 people who are selling mobiles and 68 people who are coming to buy? Okay, and each shopkeeper is having 2 mobiles. 68 shopkeepers and 68 people who are coming to buy. Each shopkeeper is having like 5 mobiles. Now the buyers can bargain. You can ask for discounts. You can say that can you bring if you don't bring down the price, I'll go to the other shop. You can do that. Fine. So that's the thing about supply and demand, right? So in National Stock Exchange, the volume is higher. That means more number of people actively participate in National Stock Exchange, and that kind of gives you the advantage that you can kind of bargain, kind of not bargain, like more number of people are there. That means you will be getting at the best price that you want. But in Bombay Stock Exchange, the volume is lesser. See, I'm not someone who's against Bombay Stock Exchange or something. Okay, the volume is kind of lesser, so that's the reason I prefer National Stock Exchange. Now, to borrow Bank Nifty or prediction, will it? No, nothing. We're not discussing anything about that now. So, just having, yeah. BSE is having more companies, whereas NSE is having lesser companies. Okay, I'll show you that as well. Just a second. I'm just sharing my screen. I hope you can. I'll just take over the website of Money Control. Okay, so all the people who are attending the session right now, you people will receive a mail of another video too. So that video kind of covers what you should be knowing. So let's consider. So that's a very valid question that you have asked. So let me just take out the website of Reliance Industries. Okay, it's taking time to load. Just a second. So this is the site called what do you say, Money Control. This site is also owned by Reliance. If you didn't know. So I'm just taking out the share of Reliance. I search for Reliance. So on the left hand side, what I see is the price of the stock 1486.65. On the right hand side, 1487.6. This is the price of the stock on the National Stock Exchange. This is the price of the stock on the Bombay Stock Exchange. And what happens is the price of the stock has increased by 0.86% on last Friday. That is by 12.7 rupee. The price has increased by 0.86%. That is by 12.7 rupee has been increased for the share. On National Stock Exchange, it has increased by 0.91%. That is by 13.45 rupee. So more or less is the same only. This is the price of Bombay Stock Exchange. This is the price of National Stock Exchange. Now, if you have a look over here, the volume in Bombay Stock Exchange is just 7,14,475. While in the case of Bombay Stock Exchange, it is 9 million. It is 9 million, right? So 9 million means 97 lakhs. So 97 lakhs is the volume traded on National Stock Exchange. In Bombay Stock Exchange, it is only 7 lakhs. That is, it is more than 10 times. That is the number of people who actively participate in trading in National Stock Exchange is like more than 10 times than Bombay Stock Exchange. So the volume is much higher in National Stock Exchange. Some of the other reasons are that I personally feel the technology that they're using is a bit more better for trading and all. Like it's kind of quicker. Okay. So over here we get some other values like previous closing, that is the closing price of the previous day. That is previous day. This is for Friday. So the previous day was Thursday. And for those of you who don't know, the markets are open from Monday to Friday. Saturday, Sunday is off, Monday to Friday. And the market hours are like 9:15 a.m. to 3:30 p.m. Market opens at 9:15 a.m. and closes at 3:30 p.m. Okay, the stock markets. Previous closing, Thursday's closing price. Opening price is Friday's opening price. Okay, so same thing with National Stock Exchange is also here. So today's low or high value. What was the lowest price and highest price of the day? 52-week high or low. What was the high and low price of the stock for the last 1 year? Lower or upper price band, that is the band, that is the range within which the price is expected, like fixed to move, but this bands can be revised. Okay, so yeah, so let's get back to the PPT. So that was a great question Chetan has asked. More companies are there in Bombay Stock Exchange, but people prefer National Stock Exchange more for trading. Okay. So let's move on with the, what do you say, our PPT. So let's have a question for you. Do you think there is a difference between a trader and an investor? Like, what do you feel? Is there a difference between a trader and an investor? Just try answering. Oh, it's already visible for you. Okay. See, I have a screen over there as well. So the PPT is being played over there. So it might feel a bit awkward me looking here, there, both the place. Yeah. So what do you feel? What is the difference between a trader and an investor? Anything like you can just try answering. If you want to mention something. So no one. Okay. Period of time over which the stock is held. Okay. Yeah. Great answer. So hi Ramin. So great answer. Yeah. Investor has to wait for making profits. Okay. Yeah. See, both everybody has to wait. Not just investors, even traders has to wait. So there's this term like the stock market. Like people feel that okay, if I'm trading in the stock markets, I should get into it. I should as soon as the market opens, I should buy. I should sell. I should keep buying, selling. It's not that way. It's like it's something that deals with your patience. Okay, you should just wait, keep looking at the screen, look out for opportunities, and it's like once in a while that you get like really great opportunities. But you should make sure that you're making the best out of it. Okay, you should be making the best out of it. That's the role as a trader or an investor. You should make the best out of it. You should be patient. So the stock market is more about stocking the markets. You keep stocking it. Here and there you get opportunities, you make use of it. That's it. So the difference is that as a trader, you can make money if the market is up or down. So I told you if the market is moving up, you can make money. You can buy something, you can sell it off at a higher price. So that is what we mean by long positions. You take long position meaning you buy something first and you sell it off at a higher price. What we mean by long positions. Now, when I say short position, what we kind of mean is you sell something first and you buy it back at a lower price. You sell something first and you buy it back at a lower price. We just like we discussed earlier case, the borrowing one, right? You sell something first and you buy it back at a lower price. So long position means you buy it first and you sell it off at a higher price. Short position meaning you sell something first and you buy it back at a lower price. So please don't get me wrong. You're kind of not borrowing it from your friend or something. I just explained to give you an understanding. What happens is that I told you the stock market timing is like 9:15 a.m. to 3:30 p.m. So for day trading, for people who are day trading, you have the provision to short sell, meaning you can sell something first, but you should make sure that you buy it back before the market closes. That's it. So let's say that you're selling like 1,000 quantities of Tata Motors. So initially your quantity becomes minus 1,000. Now before the market closes at 3:30, you buy back 1,000 shares. So minus 1,000 plus 1,000. That makes the quantity zero, net quantity zero. So even though the trading happens during between 9:15 a.m. to 3:30 p.m., the final settlements in the stock exchange always happen after the market has closed at 3:30. So when they kind of do the settlements and all, when they check, you have sold 1,000, you have bought back 1,000. That means net quantity is zero. And that's kindly totally permitted. Okay. So yeah, so many of you have given answers. So for example, like Syed, quick profits versus compound profit, great answer. So Saurabh, great. Uh, Paresh, the investor has to make sensible decision. Everybody has to make Paresh, not just investor. Investor less risk and no time limits or expect. Okay, less risk. Both the people have risk, but comparatively is lesser risk. Yeah, I agree. How can we sell first? So that is what we mentioned. Short selling. You sell something first, your quantity becomes negative. Then you buy it back before the market closes. Your quantity becomes positive. That's the thing. Okay, so you got me right. You can sell something that you don't even have. Zerodha or Upstocks, both are the same. Okay, it's both the same. Okay, it's like asking like Miley Cyrus or Hannah Montana. Both are the same, right? Okay, almost everything is the same. So there are websites like Olymtrade, Invest Options as well. What are they? They're scams. Okay, take my word, they're scams. Okay, they are just frauds. They're completely frauds. They ask you to add money, but you won't be able to withdraw. Okay, I know many people who have lost their money. So please stay away from these scams like volume trade, Binomo, IQ options, invest options. And I kind of keep seeing ads like you add 100, you get $100 as bonus. What is that, man? Like you add $100, you get $100 as bonus. Do you think that works? Why should they do that? You add 100, they give you 100. Doesn't work that way. Trading means yeah. So great perspective, Prasad. So trading is short term. You make use of opportunities. So you're kind of becoming an opportunist. You can say you're speculating the price. So let's say that you feel the price of the share is kind of going to go up. Okay, you feel the price of the share is going to go up. So you buy. If you feel the price of the share is going to go down, you sell. So trading is kind of, you are kind of having a short-term commitment. You study the trend of the stock. You study the charts. You study the graphs. So based on that, you kind of check for the opportunities present in it. What is the probability that the price is going to fall down or the price is going to move up? So that is what a trader does. He has no long-term commitment. He makes use of opportunities. So if he feels the price is going to fall down, he short sells the stock. If he feels the price is going to move up, he goes for a long position. Now talking about investor is a long-term perspective. Okay, long-term perspective means it's just like becoming a business partner. So as when you invest in a company, like you are going to study about the business, you are going to study about the management. See, trading is short term, I told you, right? Like you can be entering and exiting like within seconds. Okay, you can be entering and exiting within seconds. You can be entering and exiting like within minutes, hours, or you can hold for, let's say, a few weeks, or these things. Now, talking about investing is a long term approach. You kind of stay in the trade for a longer duration of time, let's say 1 year, 2 year, 3 year, 5 year, or even for your lifetime. So you're just becoming like a business partner. You feel the business model is good. You feel that the management is trustworthy. All these things you get an understanding. So only if you're kind of familiar with the business model, you also check who are the competitors of the company. Okay, who are the competitors for this company. Only if these things are there, you kind of invest in the company. So that's the thing. Okay, so long-term approach, that is investing, and trading is a short-term, something that you should be doing. So when it comes to investing, you look out for capital appreciation, dividends, and it's a liquid form of investment. So capital appreciation is what we mentioned initially. So if I purchase Reliance shares for 1,400, after like 5 years, if it becomes like, let's say, 3,400, I have received a capital appreciation of 2,000 rupees. Now that is capital appreciation. Now, the next thing is dividends. So when we say dividends, dividends is nothing else but a part of the profits that the company makes that it gives to you. So let's say that the company is making some really good profits, and the profits is going to be like taken up by the founders of the company, other shareholders also, right? So a part of the profits that the company makes, it decides to give you. So that is what we call as dividends. So dividends usually come like per quantity of shares. So depending on the number of shares you hold, you get the dividends. So liquid asset. So rather than investing like some non-liquid assets like real estate, I'm not telling you not to invest in real estate. Right now, the real estate markets are kind of a bit down, as all of you know. Okay, because of the increased stamp duty, all these things. Okay, it's kind of down now. So liquid asset is a liquid asset. That means if you want to exchange it with cash, the next day you can sell it. The money comes to your demat account. Now you can withdraw it to your bank. You can use the cash. It's a liquid asset. Now trading, you can make money on both sides. That means if the market is falling down or the market is moving up, you can make money. The reward is higher. That is, the potential to make a large amount of money is higher in trading. However, the risk associated with this it is also very high. Higher the risk, higher the reward. It's an active source of income, meaning you can say that I am working as a day trader. That means for a daily income, you can make a daily source of income by trading. Investing as a long-term approach is a passive source of income. Trading is an active source of income. Okay, so we have a lot of day traders in our community as well, who are completely dependent on stock markets for their income. We have many people who are completely into trading. They're not doing any profession. Their profession is just trading. So we are setting up our trading firm also. If you don't know, comprising of our own members working for our trading firm. Okay. So long position, short position, we have discussed that. Long position meaning you buy first and you sell at a higher price. Okay. Short position meaning you sell first and you buy it back at a lower price. Okay, just a second. So many people are going to tell you that stock market is a place where you gamble. Okay, so many people tell you that stock market is a place where you gamble. It's completely wrong. So before that, like, let me just get back to a question. Is market bad for long-term investment? No, market is always good. If you have a horizon of like 5, 10 years, the market is always good. What happens if we sell the stocks and don't buy it back? You can't do that, man. That's why we have the stock exchange. Okay, yeah. So now you must like I'm. So one question that you people didn't ask me, like, why do we have the stock exchange? So that I'll answer that question, Aaron. So Aaron asked me is asking me like, what will happen if we sell the stock and don't buy it back? So let's say that I'll give you one example. So let's say that me and Aaron, we are kind of I tell Aaron that I'm selling you my mobile phone. Okay, so I tell Aaron that I'm going to sell you my mobile phone. I take an advance of how much should I take for from Aaron? Should I take like a 20k, 30k? So for my iPhone like 11 Pro, like let's say that I'm taking an advance of like 25k from Aaron. Okay, so Aaron pays me an advance of 25k, and he tells that after uh, like the rest of the money he'll give me when we meet and when I give him the phone. So after taking 25k, I don't return back the mobile to Aaron. What will happen? It's really bad, right? I'm cheating Aaron. I shouldn't be doing that. I take 25k advance. I don't give him the phone. So that's like cheating, pure cheating, and that can't be done in the markets. And that is why we have the court, we have the police, all these things. Similarly, that is the reason why we have the stock exchange. So see, so what is going to happen is I keep my mobile phone at the stock exchange. Aaron keeps the money at the stock exchange. So stock exchange, what they're going to do is they're going to give the cash to me. They'll give the mobile to Aaron. So it's completely transparent. So both the parties are happy. Both the parties are sure. Else, if I kind of tell Aaron, okay, you give me 20, you pay me money first, then only I'll give my mobile. Think all these kind of things happen in OLX, right? People they cheat. So that's why we have the stock exchange. If you sell it, you have to buy it back. If you don't buy it back, what is going to happen is that your broker will do that for you. So we have a third party that is our stock broker. So the stock broker will do that if you don't do it. If you sell something and if you don't buy it back, your stock broker will be doing that for you. So no, nothing like don't feel that like you can sell something, you can okay, you can just stay away from buying back. No, it can't be done. Your broker will do that for you. Yeah, we have like we are recruiting traders. So from our community, it's like if you prove to be a good trader, uh, we can directly recruit. Okay, so do you have any job opportunity? Yeah, that's what I said. So all say that stock market or sure, stock market is always risky. It's risky only. But if you have the right set of strategies, you can make money. Is broker necessary for trading? Yeah. You always need a stock broker for trading. Without a stock broker, we can't kind of trade at all. So that's the thing. Without a broker, you can't trade. I'm planning to borrow money from my friend for the trading. It's not at all correct. Not at all correct. Please don't do that. Trade only with your money. Start small. Let's say you're starting with 500 rupee. If you are able to make 1% per day, that is good enough. 500 rupees. Don't think about the money first. Think about the skill. Just consider this as a like something that is going to make you rich over the next 5 years or the next 3 years, 5 years, 6 years. Think that way. Don't think that it's going to make you rich. You need to get rich in 1 month. That doesn't work. Trust me, it doesn't work. Don't borrow money from anyone. Even if you have just 100 rupees with you, or even if you have just 500 rupees with you. If you don't know, you can start trading even with just 50, 100 rupee, 200 rupee, 500 rupees, good enough to start trading. Now, once you're comfortable, once you are kind of sure that, okay, you are able to make money by trading with your 500 rupee capital, then increase your position. That means increase your trading portfolio. Don't just jump into like borrowing money. Do you think that stock market is one business? I don't know if you know or not. Stock market is like the kind of one business that you can start with very less investment. That means you just need to have a demat account which costs nothing. You need to add money to your demat account. So 500 rupee means 500 rupee you can start. Even to start like tea shop you need lakhs nowadays. You can start a trading, like you can start your trading by yourself, like with a small capital. And one more thing is that no bank ever gives you loan to trade. So if you kind of go to the bank and say, hey, I want some money to trade, do you think they'll give you? No, they won't give you. And the reason is they know it's very risky. Even the bank knows. So nobody is going to give you money for trading. Even the bank doesn't give you. So please don't borrow money from your friend for trading. So that is my humble request. Please don't do that. Okay. The stock exchange for maintaining the money flow for the companies, yeah, one way. For a newbie, no. In the sense, only for traders. Like we are kind of screening. Like right now, we have screened like shortlisted 10 people out of 500, and these 10 people out of 500 is not because like the 10 people who are making the bigger amount of money. No, that way. Who have the right skills, whom we felt is coachable. Coachable meaning like from our community itself, whom we can kind of improve them. So definitely, if other people are coming up to the levels, we'll be recruiting them as well. If you don't have a demat, go with Upstocks or Saroda. How to find good stocks? Okay, it depends on the strategy you implement. How did you start trading for pocket money? One-to-one training, no, we are not offering. Like just for our prop traders, that is what we are doing. I'll inform you that Akash, how to find good stocks to trade. It depends on the strategy. Okay, I personally, okay, before I move forward, let me just, I personally trade mostly on equities and commodities. I'm more into the stocks and commodities. When it comes to commodities, nothing else but crude oil. So I trade in crude oil and equities. My favorite list of stocks are Tata Motors, Vedanta Limited, Reliance Industries, and I trade on the index futures also. Okay, yeah, we do F&O. Strategies you use, the strategies like we have named it ourselves. So so stock market. So let's continue. So stock market is a gambling or not? So what happens is, for somebody who's gambling in the markets, it will always remain gambling. 90% of the people, as I told you initially, they lose money. The reason is that they don't know what they're doing. They have got into the markets because they understand somebody else is making money. But they have never taken the effort to kind of try and understand what is that factor that is making this 10% people rich. See, they didn't kind of start making money like in a day or two. They have spent a lot of time. Of course, like just like in any other profession, you have to put in a lot of effort. Okay, see, people are kind of willing to spend like 12 years, 4 years for some degree, but they feel that they should be able to make money in the stock markets after 1 week. I don't get that point. And one like really interesting thing that I personally have found out is that if I ask somebody like, what is it? If I kind of ask them like, what do you say? If I kind of ask them, uh, okay, you're going to put in an FD. You're going to start an FD. Okay, you're kind of going to start an FD, fixed deposit. So if you kind of ask like, how much returns do you expect in a year? Okay, how much returns do you expect in a year? They say that I expect like 7.5 percentage. Okay, fine. Somebody who is kind of putting their money in stock markets, what is the kind of returns that you're kind of expecting? I want my money to be 100 times. I want my money to be 200 times, 50 times. Okay, I want my 7% returns, 100% growth. People expect like 50% growth. Now I ask them like, what is the risk that you're kind of comfortable? No risk, but I want like 100% returns. So the thing is, depending on the returns, your risk will be defined based on the returns you're kind of looking out for. So there are many things like leverage and all. Okay, so depending on the return that you're kind of expecting, your risk will also be there. So you can't kind of look out for 100% annual returns in a year by not taking any risk. Risk will be there. But the edge is that you should be able to manage both the risk and rewards. So that is why we need strategies. Okay. So I'll tell you what has, I'll give you some insights what these people go wrong with. So they don't have any risk management. So let me tell you one basic example. So let's say that I want to kind of make 2 rupee. Okay, I'm kind of looking forward to make 2 rupee. Okay, my the reward I'm kind of looking for is 2 rupee. Can someone tell me what should be the risk that I should be taking in that case if I'm kind of looking forward to taking 2 rupee? Okay, let's forget about stock market. So let's say that you are kind of starting a business, and you have to the business is having an income generating potential of, say, let's say 10 lakhs in 1 year. Okay, so what should be the kind of risk that you should be taking? So do you think that you should be investing 100 crores to make 10 lakh returns in a year? Do you think that way? Or do you think that you should be investing like 1 crore to make 10 lakh profit? See, 1 crore if you put in bank, you'll get 8 lakh. So 10 lakhs is not something that is worthy because, okay. So if you're kind of looking forward to make 2 rupee, you should make sure that the risk you are taking in that trade should be maximum like 1 rupee or 1.5 rupee maximum when you're looking for a profit of 2 rupee. So we have something called as risk management. Many people don't know about the concept of stop loss. I still don't know why. And people, like earlier days, everything was like you call, you ask your broker to buy all these things. But now everything is automated. It's all like possible with the case of technology. So you can buy and sell uh, on your on your mobile, on your desktop, all these things. Okay, it's completely possible. Okay, so I'll just show you something. So I don't know if you are, most of you who have been into the markets, they must be familiar. But I'll just show you something. I'll just share my DMAT platform. I'll just show you. So if you kind of see, so I'll show you the platform of Upstocks. Upstocks is nothing else but a DMAT broker. Okay, so if you kind of have a look over here, so this is the DMAT broker, the stockbrokers platform that we personally use for trading purpose. Okay, so if you want to buy a stock, you can click on buy, and there's something called as OCO, where you can kind of mention the price at which, today we're not going to discuss how to place an order or something. We're not going to discuss all those things. I can define over here what should be the maximum risk I should be taking in this particular trade. See, you must have heard about people who has lost like 100% of their capital. That is, let's say they have invested 1 lakh rupee, they will lose the entire 1 lakh rupee. And I'll tell you why. If somebody who is using stop loss, it is not kind of possible. So let's say that the maximum risk I want to take in a particular trade is, let's say, uh, in this case, is the price of the share is 366 rupee. So let's say that I fix to myself the maximum loss I can take per share is, let's say, 3 rupee. Okay, so let's say that 366 I'm buying. The maximum risk I want to take is 3 rupee per share. So I can mention that even before I enter the trade. Okay, and the target, that is the price at which I'm kind of looking forward to sell. So once the price kind of moves up by, so this is just vague numbers I'm showing you, not based on any strategy or something. So I feel that I should be selling the stock at 371. That is my target. I'm buying at 366. I should be selling it off at 371. Now, if the price is supposed to be falling down, I should be selling it off at 363. So if I know that beforehand, then I can set it before only. Okay. So I should be doing that. Okay. So in that case, the maximum amount I'm going to lose per quantity is just 3 rupee. Okay. I know that. Even before I enter the trade, I know that. So people kind of don't make use of these tools. They just get into positions. They don't know the risk they're taking. So risk management is kind of like very, very important in the sense, like you should be knowing how much amount of money you are willing to risk per trade, per quantity, how much amount you should be willing to risk. only based on. So let's say that in that example I gave you, 3 rupees is the risk per quantity. So let's say that the maximum amount I can afford to lose is 3,000 rupees. Then I should be purchasing a maximum of 1,000 quantity. Okay, I should be purchasing a maximum of 1,000 quantity. I should not be considering to purchase 10,000 quantity or 10,000 quantity. If I purchase 10,000 quantity, that means my risk will be 30,000. If I can risk, if the risk I can take is only 3,000, then I should be purchasing a maximum of 1,000 quantities. So all these things is what is going to make you a good trader. So risk management, discipline. So people, they get into trades just by watching the news, just by hearing somebody else say that, okay, you should buy this or you should sell this. Okay. And apart from that, you kind of have this feeling. You look at the chart, it's kind of going up. Okay. Now your emotions are kind of going to tell you, okay, now you should enter. Come on, enter. Come on, enter. You do that, you must be entering at the high. Okay, the highest point you are going to enter. Then from there, the price has a high probability that it is going to reverse. Then you lose your money. Emotions. So only trade based on strategies. Strategies meaning a set of conditions or a set of parameters that you look at before entering a particular trade. A set of conditions that you look at before entering a trade. Okay. So that is what we mean by strategies. It's not just knowing a strategy. After knowing the strategies, you should be back testing it. That means you should be observing these strategies in the real markets. Without trading with real money, you should be writing down in a paper whether you should be taking an entry or not. If you have taken an entry, write down. If you have taken an entry on the book, how much profit you must have made, how much loss you should have made. So with that particular strategy, try out different stocks, see how your strategy is working. Find out if the strategy is giving you good results. If the strategy is giving you good results, then start off with small quantities. Small quantities meaning, see, no one friend has said that he asked me like if he should borrow money from his friends. No, you should not be doing that. You should start off with like a capital of like 1,000 rupee. I suppose like all of us are able to start off with a capital of like 1,000 rupee. You should start off with small capital, small quantities. Now, once we are sure, see, one more thing is that placing trades. That is like I showed you how to place a buy order, how to place a sell. I didn't tell you. I just showed you a basic example, right? So knowing how to place a trade itself is a big skill. So without knowing that, trading with a big capital doesn't make sense because people have this misunderstanding. If I need to get into the markets, I need a capital of 10 lakh. At least 10 lakh you need. Only then you can get rich. No, it's not that way. It's the game of compounding. So even if you're making 1% per day, that's a big amount. And you won't believe me, there are people from our community who kind of look forward to make 100% per day. There are people who are doing that from the last 2 weeks. You believe me or not, I am personally not able to do that. I personally look for like somewhat like 0.5 to 1% per day. My capital is somewhat high. That is another thing. But we have members who kind of look for 100%, 50% compounding per day. So they use a concept called leverage. That means with 10,000 rupees in your account, you can purchase shares worth 2 lakh rupee. That means if you capture a 1% move, you'll be effectively getting 1 into 20, that is 20% gains. That means if you're kind of able to perform like 3 trades on a day, that itself will, 3 trades where you're able to capture 1% moves, that will kind of sum up to like 100% returns. Okay. The risk that they're taking is also very high. So let's say that instead of getting a 1% profit, they go in 1% loss. If they go in 1% loss with 20 times leverage, meaning they lose 20% of their trading portfolio. How much risk you can take, that's completely known only to you, depending on your emotions, how much amount you can afford to risk. Okay, so that varies from individual to individual. But what strategies are going to help you with this? You will get to know if you are going to perform 10 trades, how many winning trades will you be getting? If you're going to perform 10 trades, you'll get to know how many winning trades you'll be getting based on strategy. Okay, you can observe the market using the strategies. You'll get to know if you perform 10 trades, out of 10, how many winning trades you'll be getting. So, like some of the strategies that I personally follow, it gives like 70% accuracy. Obviously, see, you must be thinking, okay, I need 99.99% accuracy. No, you don't need that. Anything above 60% is good enough. Okay, so some strategy that we follow gives us like 70% accuracy. That means if we perform 10 trades, we know that out of 10 we'll be getting 7 winning trades. And the money that we make in these 7 winning trades is higher, always higher than the money that we lose in these 3 losing trades. So at the end of the day, we are making money, and that's enough. Okay, so it's kind of not possible for you to make money in each and every trade you make. You are going to lose money. It's a part of the game. But what is going to matter to you is the money that you make in these 7 winning trades is going to be higher than the money that you lose in the 3 losing trades. So that is where you become a good trader. And back testing, even when you know a strategy, make sure that you observe the markets using this strategy for a good number of times. Good number of times. So the more number of times, the more duration you observe, you know what is the like actual probability. So we are kind of testing strategies based on algorithms, prehistoric data, using bots and all. So as an individual, you can do it by yourself looking at the charts, monitoring the live charts. Stop loss, we have discussed that. That is the maximum risk you want to take per quantity. You know that before entering the trade. So let's say that let's say that I have 100 rupees in my account. The risk I want to take per trade is 2%. That means 100 rupees. First trade goes loss, my account becomes 98. Again, it becomes loss 2%. So how much does it become? So now I'll be losing my account balance will be somewhere around like 96 point something. Then again 2%. So 2%, like is kind of impossible for you to bring down your account to like pure zero until and unless you're gambling. Because basic probability itself will give you 50% winning rate. That means if you perform 2 trades based on probability, you should be getting 1 winning and 1 losing. But that doesn't mean that first trade, if it goes losing, next trade should be winning. That can also be losing. But based on probability itself, if you buy something, the probability that the price is going to go up or down is like 50-50, right? Now, if you're implementing strategies, definitely you can increase the winning ratio to like 70%. So that is what is important. Risk reward ratios. So that is what I mentioned first place. Like, it's not just with trading. Whatever you do in life, like we should make sure that the reward is kind of better than the risk we are taking. So let me just give you an example. Okay, so let's say that somebody tells me to jump from the first floor. First floor in the sense, let's say, first floor is just assume that the first floor is like a 8-meter high or like a 7-meter height. If somebody asks like you jump from this first floor, I'll give you like let's say 10 lakh rupee. Okay, if somebody asks to someone, okay, you jump from the first floor, like 7-meter height. If you jump, I'll give you like 10 lakh rupee. So it's fine. You can consider doing that because 7 meters is not such a big height. I have jumped like when I have played with my friends and all, like not for money. Okay, like during games and all, like we have jumped. Like it's not such a big height. Okay, like trekking and all, like we do that. We jump like 7 meters, 6 meters. Like it's not such a big height. Okay, but do you think that if somebody tells you, okay, if you jump from 70-meter height, I'll give you 10 lakh. Do you think you should be doing? No, you should not be doing because you are going to die. Okay, so similarly, whatever you do in life, make sure that the risk is always lesser than the reward you're looking out for. So 7-meter height just jumping is not such something that is very risky. It's fine. Okay, nothing is going to happen to you. Okay, so the reward is kind of high, risk is kind of less. That is what we should be looking for in trading as well. Okay, I'll give you one basic. I'll give you one example too. Okay, just a second. Okay. Yeah, just give you one example. So if I'm kind of looking forward to look for a target of 2 rupee, the maximum risk I should be taking is like 1 rupee. The risk is 1 rupee, the reward should be 2 rupee. For example, like what I can say is, I'll just share something. Okay, for example, like tomorrow, like we are kind of planning a trade on now. Tech Mahindra. Okay, Tech Mahindra. We were kind of looking out for an entry at 838 price level. We are kind of looking forward for a target of 847 with our stop loss at 833. Okay, so that means our stop loss That is our risk. 838 is our entry. Risk is like 5 rupee. Target is like 9 rupee. So we are looking for a 9 rupee target and we are taking a risk of 5 rupee. So to earn 9 rupee, we are risking 5 rupee. So that's fine. To earn 9 rupee, we are risking 5 rupee. But if I tell you I'm going to risk 9 rupee to earn 5 rupee, do you think that is good? No, it's not good. So that's the same thing. Is it bad to use CNC delivery orders for intraday? So that, yeah, it's really bad. So what you should be investing, invest only in quality stocks. Investing means I told you, you're becoming just like a business partner. Okay. So people, so our friend is asking, is it bad to use CNC delivery orders for intraday so that if the stock makes loss, one can hold it till the prices adjust? You shouldn't be doing that. I'll tell you why. Because investing, I told you, is just like becoming a business partner, right? Now, when you kind of consider taking delivery for a trading stock, it is like you kind of lend your money to someone. Now, if he doesn't return back the money to you, you're making him your business partner. So that's the same way. Okay, I hope you got me. Okay, so don't do that. So now, okay, so two kinds of market conditions are there: bullish and bearish. Bullish means the price is moving up. Bearish means the price is falling down. Okay. So with that, we'll kind of wind up the session for the day. So before that, what I would like to tell you guys is like we have a detailed explanation of this, like about how to read the stocks. So that will also be shared to you. So it will be another 1 hour video. So you'll get access to that video as well. Apart from that, like some of you have been asking me like what all we cover in our like online course. Like in our online course, like what we are personally doing is we are kind of building a community of traders. Okay, we're kind of building a community of traders where we kind of share our experiences with each other along with the strategies that we are following on a daily basis. So right now the Tech Mahindra, like we had a discussion today morning to kind of narrow down on the stocks to look out for tomorrow. So we kind of discussed amongst our traders which all stocks we should be monitoring, what levels to watch out for, and what strategies to implement. So the advantage that we get is, so the advantage that we kind of get is that we get to know what are the different perspectives of the market with which people are looking at it. What are the different trades people are looking out for? Okay, and we also update on the group on our chat groups when a particular stock is coming under any strategy, all these things. And apart from that, what do you say, apart from that, like as you have asked, like how do we develop our strategies? We develop our strategies like through discussion amongst our members itself. So we have kind of different groups where we discuss about the different trades we are implementing and like the reason why we are looking at stocks along with explanation. Okay, so like these are like some of our like prop trading groups, chat groups. So and yeah, this is kind of most of them are full-time traders itself. Apart from that, we have like part-time traders. So the thing like Hitesh and all, he's a working employee. So the opportunities that one can make use of is, as a working employee, you can kind of consider trading in the commodities markets because the commodities markets are what is kind of active even in the evening hours. Okay, so the commodities markets are kind of acting uh, is open till night 11 p.m. So that even if you're a working employee, you can kind of make use of commodities markets. Okay. Now, if you're kind of what do you say? If you're kind of free in the early morning hours, so like in the early morning hours, you can kind of trade the stocks which is active from 9:15 a.m. to 3:30. So stock markets are best for trading like from 9 to 11 a.m. So the idea and all, he's a businessman, so he trades in crude oil apart from his normal working hours. So we have like clients all over the world right now. So for example, like Aditya, he's a client from UK. So he's a student in the UK who's trading. So legally is not permitted, but he's trading from the UK. So everybody has his or his comfortable time. So what we are kind of doing is we are building a community of traders where we kind of exchange knowledge amongst each other and exchange strategies too. So based on these strategies, we discuss amongst each other. We practice these strategies together for commodities, equities, futures, options, everything. So that rather than starting from scratch by yourself, you can kind of get to know what works and what doesn't work. Okay, so that is how we work, and it's kind of a long-term commitment in the sense like if you're kind of somebody who's looking forward that you can make money in 1 week or something, no, it's not possible because if you kind of look at our members, it's like it takes you at least like 2 months time to be consistent with the markets. But what we kind of assure you is that you are always on the right track. Okay, best books for trading strategies. So there's a candlestick trading bible. Apart from that, whichever book you're going to read is practice. That is what is going to be more important. uh, yeah, we actually have partnership with different brokers, so we can help you with that. Which is best? Upstocks and Saroda both are good. I have accounts with both. Upstocks is free account. Okay, so it's free to create an account with Upstocks. So you can consider going for both, and you can have account with as many demat brokers as you want. No issues. Upstocks and Saroda you can try both because Upstocks is free. Saroda you have to pay 300 rupee. Okay, so you can try with both. That would be fine. So yeah, so with that we'll kind of wind up. So if you want to like if you're kind of looking forward for a career in the markets, or if you're kind of serious about the markets to learn strategies, you can kind of sign up for our courses. If you have any queries regarding whatever we have discussed so far, like you can mail. You will be getting the mailing link through WhatsApp as well. Apart from that, you will also be getting a video where you kind of get to know how to read the stocks. Okay, how to read different stocks, and apart from that, the different kinds of markets. So all the topics that you see over here in this PPT, you'll be getting one more video. So kindly have a look at that video, and with that, we'll kind of wind up the session. So it was kind of a yeah. I'll be sharing Paresh. It's kind of a pleasure like discussing with you people about the basics. Okay. So thank you. Good night. I hope you had a great weekend. So I'll be sharing the PPT along with the video. The video is also there on our YouTube channel. I'll also share the PPT, sure. Yeah. So your question is like, if you're looking forward for day trading, it's a step two program that we suggest just for day trading. If you're also looking forward for investing and day trading, you can kind of go forward for the step three program. Yeah, you'll be added to the chat group, and it's a lifetime membership. So see, yeah, so it's not like we are going to teach you for 2 weeks. After that, see, this is a every day the markets keep changing. So the strategies that we're using right now, it won't see. Even we know, everybody knows that the strategies are not going to work after 2 to 3 months. The markets will change, so we have to change the strategies accordingly. And that's the reason, like, why our like memberships are lifetime. Because whenever the strategies change, that will also be updated to you, and the access to the chat group is also lifetime. Yeah. So thank you guys. So good night. So thanks for attending.